Good afternoon, I'm Alan Rosenfield. I'm the Chief Investment Officer here at Harmony Asset Management, and this is our latest edition of Thoughts and Comments. In today's edition, we're going to review the second half of 2019, as well as our expectations going into the next year. We're going to start with a 3-minute summary, and then stay on for all the little nitty-gritty detail. So in summary, the market's up 15% year-to-date using the S&P as our guideline. But if we go back 12 months, we're really only up about 2%. And if you go back almost 20 months, we're really only up about 3%. So for all the volatility we've been seeing, the market hasn't really made any progress. This is the chart of the Treasury yield curve going back to the beginning of 2018 versus today. And what you can notice here is the big drop in yield. So yield has dropped dramatically, and yet still the stock market is pretty flat. Why? One, global economies. Global economies are slowing down. Two, there are two wild cards which the markets aren't sure how to factor in at this point, and it's leading to volatility. The first is the trade war with China, and the second is what are central banks doing around the globe. The bottom line is we expect volatility the rest of this year and into next year, which is a presidential election year. Given that, portfolios need to be well diversified between stocks and fixed income and real estate and or commodities. Don't make big bets. Take advantage when things do sell off, but don't get greedy and stay very patient. Thank you for listening. Stay tuned for the in-depth analysis. There are 4 areas that we need to look at in detail. Number 1 is earnings. We need to look at second quarter earnings and expectations for third and fourth quarter earnings. Number 2 is global economics. Number 3 is one of 2 wild cards. That's the trade war. And the fourth and second of the wild cards is central banks. So, number 1, earnings. If you look at this chart, what we've got graphed here is revenues, the growth of revenues, and the growth of pre-tax net income for all of the companies in the S&P 500. At this point, almost 90% of the S&P is reported, so it's a very good reflection. What you can see from the chart is revenues, which is the green line, has been slowing dramatically. It's still positive growth, so revenues are growing, but they're growing at almost half the rate they were 6 months and 9 months ago. The blue line is pre-tax net income. Pre-tax net income, before taxes, before you divide it by the number of shares outstanding. And we'll explain why we're using that in a moment. But if you look at that one, it's actually started to go negative. So we have basically, let's call it, no growth in net income in this quarter. And again, for the last several quarters, it's been slowing. And we think this is going to continue into the third quarter. That's a critical element. In this second chart, what we're looking at is capital expense as a percentage of revenue versus total debt to the total value of companies. So let's discuss those for a second. Capital expense is the money a company spends to grow its business. And total debt as a percentage of the total value of the company is a way of looking at how leveraged your company is. So, and this is again, all for the S&P 500. So what you can see here is the capital expense has been pretty flat as a percentage of revenue over the last number of years. But in the last 6 months, debt levels as a total portion of the company's value has jumped pretty dramatically. So what that says to me is that they've borrowed money, but they're not using it to grow their business. What are they using it for? They're using it, 1, to buy back stocks, and 2, they're doing it to make acquisitions. Now, acquisitions can be okay, except that when markets are at peak levels, you're paying a premium. And what you historically find is they are bad investments, and they end up writing down the investment that they made by purchasing another company. So it doesn't tend to be a great way to grow your business. More importantly, by buying back shares, what you're doing is manipulating earnings per share. If you have $10 a share in earnings and you cut the shares outstanding in half, go to $20 a share in earnings. So if you don't pay attention to the earnings, you went from 10 to 20, you'd say, you doubled. Net income, so what we talked about a second ago, pre-tax net income, removes that area of manipulation. And so what it's showing us is that real growth in net income, the profits, isn't growing. Part 2, we're going to discuss economics globally. We're going to start with looking at what's going on with US economic numbers and then expand our look to Europe and Asia. So in the US, numbers have been very mixed. The most recent numbers that came out were housing, consumer spending, CPI. Consumer spending was strong. That's a real plus. The CPI was also stronger than expected. We're running at about a 2.2% inflation rate. While not large, it's going up. And that's something central banks are going to have to look at, which we'll discuss in part 4. Another economic figure was housing. Housing's been slowing for 7 or 8 months now. That's not typically a great sign for the US economy. Industrial production in the US has been slowing. Transportation numbers showing the amount of goods being transported has been slowing. None of these are negative yet. They're all slower growth. So growth is moderating. And that's why right now I do not see a recession in the United States. Could we get one next year? Possibility. It's always a possibility because it's a normal cycle. But the central banks have been pushing that off. Again, I'm getting ahead of myself. So the economy in the US is not bad, but it is slowing from its peaks. Let's look at Europe and Asia. In Europe, growth has actually gone negative. They've actually got negative production numbers. Their consumer spending has slowed. Economics, the economy in Europe does not look great, which means demand for US trade is going to have an impact on us. Same thing happening in China. Now, China still has positive numbers, but there are some other things going on in China that need to be kept in mind. In the last several months, China has taken over 3 major banks. That's not a good sign. That means they're losing control of their debt levels, and they have very high debt levels in China. Consumer spending was just reported in the last week, and those numbers are slowing. Again, they're moderating. They're not as positive as they were, but they dropped rather significantly from almost 7% to almost 4%. So you're talking about a big slowdown. Those slowdowns are reasons to be worrying about stock and bond markets. And that take back to the first part where we saw the yield curve coming down. It's part of the reason yield curves are coming down and yields are coming down is people are starting to get nervous. Part 3, talking about trade wars. Now, there are actually a number of trade wars going on. We've had fights with Canada, we've had fights with Mexico, we've had fights with Europe, but the big one is with China. But there are others. Japan and South Korea are fighting each other right now. So there is this whole level of angst around the globe between trading partners. Trade wars are never good for economies. Nobody wins a trade war. You end up with recessions because prices rise. You get inflation, and that makes it hard for people to spend money, so you get the inflation plus the recession. So they're not great things to have. But we're going to focus on the China war since they are a major trading partner. Because of what's been going on, and it's been going on for a number of years now, it's just reaching ahead. You're getting more nervousness from stock market players as well as companies about what the costs of the goods are going to be. Costs are starting to rise. At the same time, because China and the president are each jockeying for position, because a trade war is really much more than just a complaint about their unfair trade pricing against us. It's really jockeying for position for global economic power. So there's a lot going on here, and it's not going to be solved immediately. This is not a 3-week deal and we're done. This is going to go on for a while. So this is impacting markets because they're worried, because they know that typically a trade war will lead to a recession, which means stocks should come down. But every now and then you get President Trump coming in and saying, like he did just this week, well, you know what? The increased tariffs, we're going to hold off until December. So the markets rallied. The next day, China came out and said, yeah, but that's not going to make a difference to us. So the markets fell. And that's the day they fell 800 points. And there were some economic numbers that day that helped it. Then you get yesterday or today when China came out and said, well, maybe we could meet 50-50, meet in the middle somewhere. So all of this jockeying leads to these gyrations. That's why I think they're going to continue for some time, because these gyrations are having economic impact. Stocks are very fully priced, and therefore people aren't sure what to do. So this is why we think you're going to have to live with volatility and recognize that if you get a recession, if you get a slowdown in economies with the average S&P 500 stock with a PE of 23 times trailing earnings and earnings slowing, there's risk of stocks moving down. Part 4 is central banks. And when we're talking about central banks, we're really talking about interest rates. Now, as we've said in a number of times in our newsletters in the past, both video and print, we've said for a while, central banks around the world have been manipulating markets by printing money and using it to buy either treasuries or mortgages, or in the case of Japan, where they've been buying their own stocks and pushing up the stock prices. Problem is it hasn't really helped them. Hasn't generated more economic growth in Japan. It hasn't helped the stock markets particularly, but there's a heck of a lot more debt. And this is a big question mark and a big wild card, because the markets in the US are being driven by traders rather than investors. So they are all making bets on what's the central bank going to do. And this is leading to volatility in bond markets, which is leading to volatility in the stock market. So they all get linked back together. So let's look at the interest rates. We're going to look at US Treasuries. So this chart is looking at 4 time periods for the US Treasuries. The top part of the graph. That's from the beginning of 2019 is all. 12/31/18. That's the yield curve. Then the next one just below that is from the end of March of this year, so the end of first quarter. The third one is from the end of the second quarter. See how far rates have started to drop. And notice that the 10-year has gone from being up above the rest of the curve to coming down. The last curve is from today. Notice how much more it's dropped. So interest rates have been dropping fast, yet the stock market, while it's up this year, is flat over time. So what's going on? Well, the most recent bets have been that the Fed will lower interest rates, and they did. At the end of July, they lowered rates by 25 basis points. But now traders are betting that they're going to drop at least 2 more times this year, even though the Fed has said they probably won't. So what's happening here? They're front running. They're making bets for a trade. So we're getting this almost inverted yield curve, which is typically a sign of a recession, because they're making bets, not because there's a recession. And that's why at the same time this is happening, stocks have stayed buoyed up. They're up. They're doing this, but they haven't fallen, which they would normally do if you were expecting a recession. Why? Because then you get people saying, well, if we lower interest rates, then savers and everybody else will have to buy stocks. And that's what's happened for the last 10 years. But here's the problem. you've gotten to a point where it's not going to help. You're starting to get a slowdown of economies. And at the same time, lowering interest rates isn't going to help that, because you've already leveraged up companies, as we saw in one of our earlier charts. You've got consumers who are fine. They got access to debt if they want it. So there isn't this pinch that you can't get money if you want to borrow money. So lowering rates won't increase that demand. So all of a sudden, the central bank's losing one of its strongest weapons for trying to resuscitate an economy. And they're doing it when the economy's still strong, and that's a danger. It's even worse when you look at Europe. Europe is now got negative rates going all the way out, including the 10-year. So that means a saver is actually paying interest to buy government bonds. There's even a bank in Denmark right now, a major bank, that is offering a mortgage with a negative interest rates, which means that you go borrow money from the bank to buy a house and they pay you interest. Now, if you aren't scratching your head, you're one of the few. It makes no sense. And that's my whole point. This manipulation isn't going to keep working. It's working less and less. Now, why is this a wild card? Because the central bank in the US has not said whether they're going to continue to drop rates. And we're not even sure if it helps. Not until there's a recession. At the same time, the central bank in the EU has just announced that next month they're going to do a new QE. Now, if you go back to the beginning of this year, they said that they were going to stop their QE come this summer. We had already stopped ours, and we said we were going to start raising rates a year ago, which we've been doing. The EU was going to stop QE this summer, and they were going to start raising rates by the end of the year. Now they've come out and said, nope, we're doing a whole new QE. And more importantly, it's going to surprise everybody. They're trying to goad the markets to move. My expectation is they're going to announce that they're going to start buying stocks. Talk about your manipulation. They're the only ones buying stocks. Well, what will happen? Stocks will go up because people will buy them in advance, and then they'll pump money in. But now you're buying something with no economic value. When you buy something with no economic value, all you're doing is gambling. You might as well be in Vegas putting your money on red or black and hoping that you're right. That's a very dangerous situation, and it's why the markets are very concerned and very, very nervous. The bottom line is that we expect the markets to continue to remain quite volatile this year. Next year is a presidential cycle year, so you may see more spending by the government. That's fairly typical. You might see some negotiations to put off the trade war to help the economy. So next year could be an up year or not. It's going to be a tough call. So we're not going to try and call it, because that's not our job. Job isn't making predictions, it's running portfolios in a logical way to take advantage of what the possibilities are. So what are we doing? We're running very diversified portfolios. Yes, some stocks, some fixed income, some real estate in some cases, depending on the suitability for clients, and some commodities, oil and gold. These all are ways to balance all these differing issues that we don't know really how it's going to lay out. And part is actually even cash, because for the time being, you're getting 2% in cash, which is more than you're getting in the S&P 500 right now. Don't make any big bets. We don't get greedy. We don't have to make a fortune every time. If we can earn a decent rate of return, we've done a good job, because we've done it by not taking much in the way of risk. It's not just what return, it's how much risk you took to get it. So we want to moderate our risk. Patience. We need to be patient, because we expect this could go on for a while. And lastly, stay calm. Thank you for listening. If you have any questions, feel free to reach out to us.